Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1326A and today's date is July 7th, 2017, and the title of the episode is Massive Inflection Point Headed Our Way. Will this lead to a crash this fall? Let's get into the economic collapse financial news. Now, we've been seeing strange things happen in the market, especially with gold and silver, where all of a sudden someone sells, thousands upon thousands of contracts, brings down the gold price and the silver price, and we know that this is complete manipulation. We also have seen on the stock market where Amazon all of a sudden just dropped out of nowhere. Now, they're saying these are all glitches. And just last night, we had a silver flash crash. Now, this is being reported as a glitch. And this implies there was no person or fat finger banker spoofing the market. It just was a computer error. And all of a sudden, 8,200 contracts were dumped into the market in 5 minutes. And silver dropped 6% before all of a sudden snapping back. So the question is, because we know that these markets are manipulated, we know that they use these systems. We know that the Fed has a trading desk. We know they have a computer system where they can make the market go up, they can make the market go down, they can make the market do whatever they want. And the question is, are these really glitches, or were they planning on doing something and then all of a sudden change their mind? Because these are becoming more and more frequent, and we can see at this point that a lot of this doesn't even make sense. Actually, the market doesn't even make sense because things are not adding up. Because look what's happening in the retail market. Look what's happening with corporate tax revenue. So for the market to continually move up and up and up, something does not make sense. Plus, we know central banks and other countries around the world, they've been buying a lot of tech stocks. They've been basically keeping the market up there in the tech sector. So we know that unemployment's manipulated. We know the market's manipulated. We know GDP's manipulated. Everything that we've been looking at is completely manipulated. And people say, well, how do you know this is manipulated? Are you just saying it's manipulated? Because when you put all the pieces together, it doesn't make sense in what they're reporting. Let's look at the new BLS report that they put out. They said they added 222,000 jobs. Now, the BLS reported that 31,000 employees, they couldn't work due to poor weather conditions, which is roughly in line with the 35,000 average for June. And yet, some 221,000 workers who usually work full-time could only work part-time due to the weather last month. Really? In May, the weather was that bad? All right, that doesn't make sense at all. And then we look at this and we say, okay, where are all these jobs coming from? Now, we know that retail, they're closing stores. We know a lot of people are being laid off. We know that the food industry, well, the restaurant performance index is dropping, traffic is drying up, and this is where all the workers are basically moving into. Now, we know that the corporate jobs, they are still laying off. So they're continually telling us over time that we're adding retail jobs, we're adding the food service jobs, we're adding health jobs. And when you look at this is just all part-time stuff. We haven't really added manufacturing or real good full-time jobs. Where they're telling us all these jobs are being added are basically in the part-time world. So the question is, how did the June payroll surprise so strongly to the upside? Because we know that ADP, well, it looks like they were dropping in the amount of jobs that were being added in the private sector. Well, it was because of local government. They hired 35,000 jobs in June. And they're saying that the food service industry and drink places, well, they added 29,000 jobs. And we had the health sector, we had education. And when we look at this, we can see that these are all part-time type of work. Some of the government jobs, they were full-time. But then they also said that the retail sector added 8,000 people. Really? with all these stores shutting down, with these stores declaring bankruptcy, they're adding employees to the retail sector. Even if they added 8,000, how many were lost? What, 8,000 added to Amazon, let's say? And what, 75,000 lost in the brick and mortar business? That's not a plus to the economy. That's a loss of jobs. And we can see that these numbers are moving in the opposite direction of reality, because they're not even making sense anymore. Because when you see 3,000, 5,000, 8,000 stores close, you know that these jobs are completely lost. Where are they going to get jobs? Where, at another retail manufacturer, or another retail store, I should say? No, because too many of them are closing right now. So we could see that these numbers really don't make sense whatsoever. And as we move forward into this year, well, we're going to have the manipulated numbers, the BLS, the GDP, retail sales, housing sales, and all these other things. They're going to be heading in one direction, into manipulation world, and the reality is going to be going in the opposite direction, and they're going to be separating, which we've been seeing for a very long time, which tells us that these manipulated numbers, they're really not making any sense at all. Now, let's think about this for a second. We have retail businesses that are closing down. People are losing their jobs. There's more and more real estate that's going to be basically empty out in strip malls, in malls, and a lot of these strip malls and malls, they're going to be going bankrupt. A lot of these retail stores are going bankrupt. A lot of small businesses are going bankrupt. This is not because of online. It's because people aren't making the same funds like they used to, because they're getting laid off and they only can maybe find part-time jobs, or they can't find jobs at all. So they're not making the same salary as they were. Now we're seeing commercial Chapter 11 bankruptcies. Well, they're on the rise. They've jumped 16% year over year in June to 581 filings across the U.S. And these are all types: large corporations, tiny sole proprietorships. And we can see that coming from the American Bankruptcy Institute, we're seeing that there are more and more filings that are occurring right now. Now, the next wave of these bankruptcies, well, it is building right now. And large and small retail operations, well, they're at the forefront. And we need to remember something very important, that when we see all of these stores close, these are the big chain stores. We also have to remember there are many mom and pop type of stores, fashion shops, and things like that that are closing. So we have those piled on top of the chain stores, which we can see we're having a complete brick and mortar meltdown right now. And again, as we move forward, we're going to see a lot more of this. We also see consumer bankruptcies. They are rising right now. Now, the primary cause for the increase in filings are the $1.12 trillion in auto loans, the $1 trillion in credit card debt, and other consumer loans. People, well, they spent the money, and now the bill is coming due, and they don't have the funds to make these payments. Either they lost their job, or they lost their job and they got a part-time job, and making ends meet becomes very, very difficult. So we're starting to see a lot of consumer bankruptcies now on the rise. The same with commercial bankruptcies. I mean, we're heading into an area where it's going to be completely one gigantic disaster. Now, an analyst in Bank of America, this analyst has written that over the next 6 months, higher interest rates will likely be much more negative for stocks and credit, yes, credit, given new central bank policies. Now, we can see that we're at the end of this credit cycle. And we can see that the central bank is raising the interest rates. We can see that they're going to try to unwind their balance sheet. And what this analyst is saying is that by the Fed tightening, and by the ECB saying that they're going to be tightening, well, the bond yields, they're going to be rising. And the volatility is going to be reducing the tech stocks. Now, the Bank of America analyst says when looking at near-term catalysts, he views this summer of 2017 as a massive inflection point in central bank liquidity trade. As this all happens, this analyst is saying that we will likely lead to a big fall in the market, most likely during the autumn time period. And what they're saying is they're looking at going all the way back in the past of when the Fed was tightening and when things started to turn downward. And they pinpointed when the Fed reaches the interest rates around 2% or so, very close to 2%, this is when the market is going to start to fall apart. And he's expecting the Fed to raise the rates once again, and maybe twice before the fall, which will bring us to that point in time of where we're very close to that 2%. And what we're seeing right now, if we go back in time, we can see that this has happened pretty much almost every single time, going all the way back to the Great Depression of 1929. Every time the Fed tightened, where they were raising rates, the market crashed. Now, the last time we saw this was back in 2007, where they were raising the interest rates in 2005, 2006. They got it up to a certain point, which was around 5%, and then all of a sudden, things started to completely fall apart, and the entire system fell apart. Well, we are very close to that period of where we're going to see the market fall apart. And if it does hit this point, we will start to see everything come apart and the entire system will start to fall. Now, I believe that they're going to do this in two parts. Yes, the market might fall during the autumn time period, but the Fed, which they want to do, they want to step in and they want to push stimulus and they want to lower the rates at this point because they know they can't raise the rates. And they're going to lower the rates, maybe even go into negative territory, and they're going to ramp up stimulus. And they're going to say that they have saved the economy. And they're going to continue to pump in as much stimulus, and they're going to drop the rates dramatically during this period of time. And of course, the corporate media, they're all going to say, look what the Fed did. They saved the economy. And once the economy is pumped up a little bit, where they say, okay, it's recovering now, even though it really isn't. It's only the stock market. Everything else is going to be falling apart like crazy. All of a sudden, we're going to get hit with some type of an event, which they'll blame this on maybe Trump. Maybe they'll blame this on a cyber attack, because a cyber attack will be very easy for them to use to say, listen, yes, it was a cyber attack on the financial institutions. We had to close the bank. And they really have to show no proof, because we can see in the past, with everything that has been done with the Russian hacking, the DNC attacks, with the Sony attack from North Korea, which really never happened, they really didn't have to show any proof. They just have to come out in the corporate media and tell you that this is happening. And most likely, this is what they're going to do during this time period. So we're probably going to see something, if this analyst is correct, and we know there's a lot of other people like David Stockman, Charles Nenner, Harry Dent, and many others that are saying that, yes, during this time period, it looks like we might have a major problem. Now, if they boost it up, we might see the market come down once again, probably in the spring time period of 2018. And of course, they're going to blame this on something else. So they'll pump it up for the next couple of months, and then all of a sudden, the whole thing will come apart, and they'll have to close the banking system, they'll have to use bail-ins, and the fun starts. This is when the real collapse happens. So we're watching this very carefully. We're listening to what all these individuals are saying. We're looking at all the indicators, putting them together. And again, this is not something that you can just pinpoint and say, yes, it's going to happen at this point in time. But with all the indicators, and you add them all up and you go back in history and you put everything together, you can get a general idea of when this is going to happen. And we have never seen, except to the lead up of 2008, an economy fall apart like this before. I mean, yes, if you go back to the other recession points in time, even if you go back to the Great Depression, you can see leading up to that point, things were breaking down dramatically in the real economy. I'm not talking about the stock market. The same thing's happening here right now. In the real economy, things are breaking down rapidly, and they're very noticeable if you're looking. If you're not looking and you're listening to the corporate media, you think everything is okay. If you're listening to the Fed, you think things are fantastic. And again, with Yellen, who says we're not going to see another crisis in our lifetime, to me, that's the signal. They just let you know that, yeah, it is coming right now. So get prepared, get ready, because this is going to be a very interesting summer and fall. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.